Hi, morning. Great to have you today on ET Now. Kamlesh, your funding costs, from what I look at it, have fallen much faster than asset yields have improved. Should investors expect this spread benefit to translate into higher NIMs over the next few quarters?
Good morning. I wish so, because the cycle of lower interest rate had just started before we face this macro headwinds of US-Iran war and all those stuff, leading to higher inflation probably. So if the rates are held on as expected by RBI and the liquidity flows in as expected, I think we should expect these rates to continue and hence higher NIMs.
Mr. Gandhi, 5.5% sequential this quarter. That looks strong at the outset itself. Can that sustain? And if that does, you could well do the higher end of that guided band of yours, 20 to 25%. You'll probably do closer to 25 for full year.
We are very optimistic that we should be doing anywhere around, say, 22 to 23%. Can't predict it, but we are anticipating a growth of 22 to 23% in AUM. We will try hard to reach to the higher band of 25%. But having said that, if you see the current quarter's performance, it has been in high quality growth with close to 21.5% growth in AUM and 27% growth in profitability on a consolidated basis, reflects the operational efficiencies that are set in now.
Right. Mr. Gandhi, nearly 80% of your AUM growth continues to come in from the MSME sector, right? Given the increasing competitive intensity in secure MSME lending, do you see this mix change or evolve over the next 2 to 3 years, particularly with faster growth in two-wheelers and housing finance?
See, as far as the opportunity in MSME is concerned, that is huge. We have a huge opportunity in MSME financing. And if you see our presentation, we have given one report published by SIGB that there is a huge gap in serving this segment. But having said that, we believe that we should have a diversified asset as we increase our balance sheet size. And hence, we will be focusing on wheels portfolio also. So in that context, the MSME contribution might marginally decrease. But however, will remain predominantly an MSME financer.
And, wheels, that portfolio is growing, I can see, and it's growing well. But off a low base, can you grow faster?
We expect so. With going forward, stabilizing our distribution channels. And as we get confidence on the risk-adjusted return that it can generate, it on a lower base, it can grow at a faster pace. That is what our expectation is there in medium to long term.
Mr. Gandhi, that you're growing slower because you want to test the portfolio a little bit longer before you start growing fast? Because 2,000 crore odd in terms of the portfolio size, and you've done what I believe 15 odd percent in terms of the growth number, 16% maybe in terms of the growth number. That's a far cry from your overall blended of 20% plus.
So that is what I was sharing with you, that once we get the confidence on our distribution channels and once it proves its metal on the litmus test of risk-adjusted returns, the same will grow at a faster pace. But as you know that we are never in a hurry to grow a portfolio. We take our own time to grow the portfolio, but we prioritize risk and profitability.
And what are the early signs showing you with regard to the wheel segment? Is it showing you that you'll likely be comfortable with regard to growing this segment at a faster clip? And if so, in which quarter does the inflection point come?
No, we do see positive signs there. And hence, I shared earlier that that portfolio will start taking some share from our MSME financing, making us a real diversified on the asset base. And I think as far as two-wheeler is concerned, Q3 should be Q2 and Q3 combined should give a good growth being the festival season. And as far as commercial vehicle is concerned, we'll take still 1 or 2 more quarters to grow it faster.
The cost of borrowing number has shrunk very sharply, right? 14 bips QOQ is really no mean feat. I mean, even YOY, the number is impressive, but QOQ especially. Could you give us some color on what exactly has transpired?
So if you see, I'll take that right up to the COVID era. That post COVID, the borrowing cost had increased substantially. And if you see our historical borrowing rates, and we have shared the data right from the 23 financial year 23 quarters, that we were below 9% in our borrowing cost. So I think with reduction in MCLR, that being transmitted over a period of time, and our efforts to find out lenders who can give it as a better rate, it's a combination of all the efforts that yielded these results. And if this continues, and if the repo rates hold on and the liquidity is sufficient enough in the system, I think we'll be in a position to maintain these rates.
Mr. Gandhi, the street is curious to know how is it that you're going to be leveraging tech now to try and evolve and garner more business going forward?
So we always give a detailed presentation on how we are utilizing tech, and that is reflecting on our stabilization of our operational cost also. So we have a 100-member team on as far as the tech is concerned. We have a build and operate model where we have the complete loan origination system and loan management system on board. We have started using BRE extensively by using the data what we have with us over all these years, and accompanied by AI. So there will be a very progressive movement as far as the tech utilization is concerned. That will not only kick in efficiencies, but I think that will also help us uh, give us better results on our credit assessments, and hence the quality of the assets also going forward. So use of tech is an integral part and is an area of focus as far as mass is concerned.
Okay, Mr. Gandhi, thank you so much as always for coming in, speaking to us, and good luck for the quarters ahead.
Thank you. Thank you so much.